Good morning, everybody. We're going to let some more people fill in the room here, and we'll get started momentarily. All right. Well, let's get started. Allie, welcome everybody to the March 2025 edition of the monthly webinar we have here. Again, we're doing a market update today, and Allie is going to do a deep dive into ERCOT. So why don't we get started here? Again, my name is Scott Ebeling. I am the Director of Pricing and Strategic Solutions. And with me is Allie Black, and she's the manager of our Pricing and Strategic Solutions team here. And we are very excited to deliver this month's webinar. It is one day away from spring, and we've got some discussions here on what happened this winter and kind of what to expect going forward here. Without further ado, we're going to, again, this agenda here about Box. We're going to do a market update, and we're going to do an ERCOT deep dive. And without further ado, Allie will take it away here and talk about everything about Box here, our little marketing plug for the month. Go ahead, Allie.
Awesome. Thank you, Scott. Good morning, everybody. Thank you so much for joining us today. In case you don't know Broker Online Exchange, you don't partner with us yet, maybe you just saw something on LinkedIn or Instagram or something that brought you here. Broker Online Exchange would like to formally introduce ourselves. We are your ultimate commercial energy brokering partner. We provide independent energy brokers and affiliates with access to all top electricity and natural gas suppliers, instant pricing, and cutting-edge software, all supported by industry experts. We've become the largest network of energy agents, brokers, and consulting firms in North America. So our resources, our scope is huge. We connect a variety of diverse energy partners, so each can benefit from streamlined, efficient options in deregulated gas and electricity markets. You can see all of those markets in the slide that we have up here. You have natural gas options available in green, natural gas and electricity available in blue, and some limited availability in a kind of darker gray color that has some stripes on some of them. Those markets are deregulated for large commercial, industrial, and manufacturing users, generally in the natural gas space. If you're a big enough natural gas customer, chances are you may be able to shop. So if you have an opportunity in one of these markets, we're happy to take a look. It's as easy as calling us and getting registered and reaching out to your dedicated account manager, which you get as soon as you're onboarded, by the way. You get a person who is your primary point of contact who you can call literally whenever you want with any question that you have. So another benefit to working with us, you'll see on the next slide, our very large vetted supplier network. You'll see some names and some brands that you recognize here: Constellation, Direct Energy, Champion. We've been doing a ton of work with them lately. Shell Energy has also been incredible over the last month, just really putting in a lot of work for some complex deals for us. So, but we have a very robust supplier portfolio. We're happy to put it to work for you. Signing up with Box means that you get access to every brand, every market. So if you're focused in your, in your area, your locale, but you have a customer who may have locations outside of your market, your specific, your neighborhood, we're able to help with those too. And like I said, it's as easy as making a phone call, just asking, okay, what do I need to do? What are my next steps? We're happy to help. And our partner suppliers are happy to help us too. Due to the scope that we have nationwide and the relationships that we have across the industry, and really just really thanks to all of our current network and how large it's become, we have fantastic relationships. We have fantastic resources all across the industry in every market. So if you guys are looking at something and would like to discuss it, want to toss it around a little bit with respect to a supplier, with respect to a market, let us know. The other thing we want to mention, just as part of our introduction, is our access to our Box Strategic Solutions team. That is led by Scott and myself, but we really want to give you a competitive edge, or the competitive edge, in energy consulting. We are really, really happy to dig in deep with your customers, to do some analyses at a component treatment level, to get into it with suppliers if we feel that a contract is not being honored, or things like that. We are happy to, like I said, lend our resources. We provide tailored sales strategies at the individual customer level, providing strategies that are really totally bespoke to that customer, to their goals, to the way that they want to the ways that they want to perform, whether performance or cost management is more important, and providing a high level of service all throughout the contract. It's not a transactional relationship, it's a mutually beneficial consulting relationship. We're able to provide data-driven insights. We do have our reverse auction platform, which helps them to optimize anytime that they do want to transact. We specialize in contract negotiation. Like I mentioned, our resources and our relationships across the industry are very good. Scott has written several of these contracts. We have teams who have worked at suppliers who have written several of these contracts. We know what we're looking for. We know how to negotiate on behalf of customers. We know to ask for things that customers may not even know to ask. So, and again, just happy to help. And like I said and mentioned, our seamless client support and proactive solutions. We are here for the entirety of the sales process, whether that's speculating and dreaming big about what types of customers you could talk to and how you could help them, or whether we're at the very end of a contract and there's something that's happening, and we're doing a forward look at their renewal. We're advising them on, how their contract is performing. We're providing budgetary reports, etc. Anything that you guys need, we're here for it. So with that, I will pass it back to Scott, who will give us our market update. I know there's a lot going on.
Thanks, Ellie. And one thing I want to talk about in this slide here is that, they say, and I love the quote, and this is what I use it for too, like ChatGPT. Everybody's kind of familiar with ChatGPT now. That you've probably been living under a rock the last 2 years, but they say ChatGPT is your thought partner, right? They use it as your thought partner, right? And like help it write emails. You need to put an email in there, and then you toss it out and it approves it, or any script or writing or any kind of questions you have, and utilize it for that. And I can go on and on about it, right? So really, I want to put out this: the Box Strategic Solutions team is your free thought partner. It's free. We are your thought partner. We will help you figure out ways to win deals, to best serve the customer in a strategy. So just think of that. We're your free thought partner. Sorry, we don't have an app. You can just go on your phone and voice something in there and we spit it out. No, you probably have to interact with us, but a phone call, a text, email, whatever, not text, but phone call or email, perfectly fine. We can get in a phone call. But yeah, think of us as your thought partner. With that, I will now go into the market update. Thank you. The market update. Before I get into this, I just want to say in the market update that, a lot of people think it's winter's over. Yes, spring is starting tomorrow. Crazy enough, in Chicago, we get some snow on the first day of spring. Yes, that's typical. But what I want to get to is, a lot of people think winter's over, good, volatility is going to end, it's going to be an easy market. No. This has totally changed now. With the winter we had, really kind of some below normal temps, and where storage went, and we'll get in the theme of this, winter, the volatility doesn't end. It's not like last year, where the volatility kind of even out, there was nothing really going on. The volatility is not going to end, and we'll get into that in a second. So I just want to put that out there first, and we'll talk about it again in a few minutes. First, the pricing update here. Not huge movements anywhere. Yes, heat rates back in 27, 28 came off quite a bit, where prices came down on the power versus gas. And we've been talking about this for a while now, where we felt power was more overvalued than gas. We still feel it is slightly, but not a huge amount, but there is some error still to come out. Going into some index prices here, and this is historical charts that really here's ERCOT North Hub, and really kind of, no big fireworks here at all. Average price now over the last 3 years is 47.81. Gosh, you take out that's that August of 23, and it's down in the low 40s or upper 30s. So very quiet markets there. PGM had a little more active winter, and you can see that they're in January and February, and a little bit in March. It's March year to date here. It's probably going to come off somewhat. And we got 3-year average here of 46.65. And in NEPOL, first time we're introducing this one. Yes, we had big time winter here this winter. Large big prices, especially compared to last year. And again, that's because of the colder weather. And on margin and gas there, you see all has to do with the basis gas. And on the margin and gas there is, of course, they're competing with Europe and other foreign countries for the LNG. And so they're going to be paying those kind of prices of $13 to $15 a BCF. And that's just reflected in the basis gas, which is supplying the generators and the margin, and that's really making the cost of power go way up. And oh, by the way, I want to mention everybody, all these charts are now on our weekly report. We got a weekly report that comes out on Tuesdays, and most of these charts here are all part of that weekly report. So they're updated on a weekly basis. So feel free to use them and take them and glean some insights from them. So U.S. natural gas storage, we luckily in the last month here or last couple weeks here, we've kind of had a little softer withdrawals, but we're still well below the 5-year average. I think we're below last year, close to over 600 BCF compared to last year. And we were at the top, we were at kind of highs, and now we're down with 1 year that's lower than this one, but still below the 5-year average. And really, this is where we really get into the point of the summer, or the volatility continuing. This summer now, natural gas generation is taking up more and more of a slice, right? And so if the summer is warmer than normal, we're going to have larger withdrawals. In fact, I will make a prediction right now that we will have smaller injections. I will make a prediction though that we could likely have a withdrawal this year. It'll be small, but one of the weeks there may be a withdrawal in the summer. So with this abating, we're here. This is what's causing the winters to go out and next in 26, and also the rest of this curve and the rest of this year, because they're going to need to refill this. They're going to need to get to a healthy level here of at least around a probably like a 3.8 level to really to make this where it's not going to be a dangerous situation looking at it for next year. Yes, we saw this 1.6. We don't want this thing to get below 1.5. That's when we start getting bigger numbers up. When we get below 1.2 or 1, we're talking potentially $9, $10 gas. So we need to get injections in the summer, and any sort of things to kind of like cut that down are going to like get in there. And this is why another theme we have is a higher floor here. So enough about storage for right now. Rig count, again, just hanging in there. Just not, the whole plan of the drill baby drill thing isn't really necessarily happening. And for one, just because they want to make sure that they're making money. These companies are in the business to make money, and they're not going to drill unless they need to make money. And so natural gas rig count is just hanging in here. Yes, they're still drilling rigs and still producing. It's just not, the production is not skyrocketing like it should. And here's the picture. Yes, we had this 105.8. That's a big reaction to the prices being higher. That is right about in line with the record of production, but these producers now are becoming much more flexible in their production. It's not just a straight, a straight, or not straight, but a right higher curve going up here, like we've had in the last 15 years of gas production. They're trying to wait and see what's happening. We need the production to continue to go up. What level that is, we'll figure out. Because one reason why here, look at this, LNG export capacities is continuing to climb. We're at 17 BCF a day. We're averaging a daily basis for around 16.5 with the capacity right now for 17. Close to 19 by the end of the year. And this is it's going to continue up higher here for the next couple years. So without this, a 10 BCF increase in production, we're going to have issues again. So and so we'll see what happens here. And this will be kind of a theme here going forward to just production keep up with this, because these are happening. These will happen, and there is demand for this gas. Next up, let's look at this. We showed it before, and we'll show it again here. This is an important chart for anybody in PJM, and this is the annual peak load kind of projections. And you can see here how these are just, this is from PJM. This is their projection, and these have increased from last year's forecast. So we're looking at a 30 gigawatt, 30,000 megawatt hour, 30,000 megawatt increase in demand, in summer demand, and winter demand's climbing up just as much. Mostly due to data center growth. I think everybody's seen those articles. This is, going to rest to see what happens here. And again, this is going to have an impact on gas generation increases and other things, and just really to see if the grid can keep up with that sort of demand and the capacity of it. So there will be a tightening of capacity. That is for certain there in PJM. And then this is, just want to go over this. This is a piece, and by the way, PDFs are in the thing here, and this is another piece we put out last week, I believe, our team did, about talking about a higher floor on a softer ceiling. So there on the right of the screen, that's the PDF that was sent, that's available, and we also put it into the handout section here of the webinar. But just to summarize this and just talk about it a little bit, we see really a shift here of a higher floor, softer ceiling, really increased LNG exports, disciplined production. Natural gas is remaining a key driver of electricity pricing. So it's going to influence those overall costs as well. So both gas and power. LNG exports have tightened domestic supply, and that trend, we're looking for that to continue. Power generation demand surge, again, just with data centers and everything coming online, natural gas consumption for electricity generation is increasing, as we talked about. Next is producer disciplines limiting supply growth, unlike past booms. Really now they're focusing on capital efficiency. They actually want to make money, believe it or not, and the backers now are definitely holding into that they make money. So this is just preventing the supply surpluses that we've seen in the past, and also with the discipline, they're not going to be as quick to jump on things as always, and that's where I'm talking about a softer price ceiling, for instance. We could have these short bits of volatility. And lastly, really, and this is the important part, government policies are aiming right now to ease supply constraints, infrastructure development, and permitting take time, and they are. I mean, I really, really truly believe these are going to have an impact, but they're not going to have an impact right away. This isn't going to happen next week. Economic fundamentals are still very important. Policy shifts, alone aren't going to drive production and pricing. And really any policy-driven supply increases, these take years to materialize. New generation, new pipelines, and new regulations or cutting down on regulations. These take time. These decisions don't happen and they don't get built. These things don't get built overnight. So they get in courts for years and all that. And the same thing with really kind of new kind of generation types like geothermal and small nuclear reactors. These really won't be more, they'll be more of a next decade thing than a 2020 thing. So with that, let's just go on to the chart of the month. And this is one that really caught my eye. This shows the kind of geometric growth here in batteries, and how this is just greatly increasing. So we're in this 47 gigawatt area. A lot of this is in ERCOT, and a lot of this has really helped out with keeping prices down this winter and last summer. And so, I mean, look at this. In 2020, we were at like 2 gigawatts of operating capacity. Now we're at 26 gigawatts, and we're almost on pace to double that this year. So these batteries, again, they don't run continuously, but what they do is they help get over that when we need that peak demand, because you can charge them up and they run for 2 or 3 hours, and you charge them up again when power prices are cheaper, and then you run them again for 2 or 3 hours when prices are higher. So it helps kind of put somewhat of a cap on electricity prices in the areas that are putting that, because they're almost like a peaker load, the new peaker load kind of thing, and they're much easier to dispatch and just go on. So this is an interesting story. It's really interesting to see this. It's great to see this. Hopefully we keep up with the supply of batteries in this technology, and also the demand. It'll be a cost savings for all consumers in the end, both businesses and residential. So with that, I will now pass it over to Ellie to do a deep dive in ERCOT. Take it away, Ellie.
Awesome, Scott. Thank you. Great market, great update. We're going to get into ERCOT today. We're going to do a little bit more of a deep dive and a market focus. There's definitely a lot going on. There have been a lot of reports, a lot of news around ERCOT, and with Texas getting as cold as it has over this winter, it's absolutely worth talking about. So ERCOT, or the Electric Reliability Council of Texas, is responsible for managing the flow of electricity to over 26 million customers, representing about 90% of the state's electric load. I knew this before, obviously, but Texas is big. ERCOT is big. It's huge in comparison to the other ISOs. ERCOT certainly has its work cut out for it. So they oversee the wholesale electricity market. They work with grid operators to make our grid more reliable. They are responsible for transmission planning all across the state, and they are regulated by the PUCT, or the Public Utility Commission of Texas, and the Texas legislature. So they're not necessarily the only ones who are making decisions, but these guys are the ones who are responsible for keeping the lights on. And that has proven to be a challenge over the last few years, and I think it's going to continue to be a challenge moving forward, given the dynamics that we're seeing. So a little bit, ERCOT also functions differently than just about every other market that we work in. Definitely functions differently than PJM, New York. It's got different ancillaries. It's got a different and a foundationally different structure than a lot of the other markets that are deregulated. So getting into these market basics, ERCOT is an isolated grid. A lot of this really came about whenever they were setting everything up. They operate almost entirely as a standalone grid. This means it's not necessarily subject to federal regulation by FERC, the Federal Energy Regulatory Commission, giving Texas really more control over its energy policies. There is unfortunately a downside to us being that independent, in that we have limited availability to import electricity from other regions. So that makes us a little bit more vulnerable to supply shortages. That really has not been an issue until about the last decade. Texas has always been a hub for oil and gas, for energy. We still have huge drilling operations, going for natural gas. We we produce a lot of energy. And in general, the school of thought has been, we don't necessarily need to import any energy from anywhere else. We have our own. We have our own fuel. We can build out our own transmission. We can build out our own wind farms, and we have. But it makes us a little bit different than every other market because we don't operate as a capacity market. We operate as an energy-only market or a scarcity market. That means generators only get paid for the electricity they produce. In every other market, generators are compensated for maintaining reserve capacity. That means that generators get paid just to sit there. Whenever we talk about capacity components, whenever we talk about capacity costs in PJM, in New York, in New England, capacity is really truly that is the cost of keeping those generators online, even if they don't necessarily have to ramp up their operation. PJM, like I said, or New England, they use capacity markets, and those generators get paid to sit there. The system can lead to lower electricity prices, but it also raises concerns about our reliability. So basically, by avoiding interconnection, by avoiding regulation, by avoiding being in a capacity market and assuming that generators will build out assets and then show up when the price is attractive enough, that has unfortunately resulted in some pretty significant concerns about reliability, particularly during extreme weather, which Texas is having at really both ends on the peak season. We have definitely become a dual peak market. And we'll talk a little bit more about that on the next slide. Scott, can we go back one sec? We also have heavy reliance on wind and solar. Not many know that Texas is actually one of the more renewably generated markets. We lead the US in wind energy production, and we have rapidly growing solar capacity. We're more dependent on these intermittent renewable energy sources than other ISOs, which is one of the reasons why we have these reliability concerns. So that, in addition to the lack of a capacity mechanism, really creates some challenges for our reliability. And the other thing, which we'll definitely see on the next slide, is we have kind of unique demand growth. Unlike a lot of other markets with pretty stable demand, Texas is growing. People are moving to Texas. I think it was, a decade ago that I heard a stat that there were 1,000 people that moved to Texas a day. And that was pre-pandemic. I don't think that number has changed other than to rise, really. So due to our population growth, due to the amount of land that we have, that people can build out things like data centers or manufacturing facilities, and really industrial expansion with manufacturing, petrochemicals, etc. And with everybody taking all of their resources and building out these big data centers, building out these cryptocurrency mining operations that require absolutely massive amounts of electricity, we have a high amount of growth that's happening and triggering a ton of demand. If we weren't growing quite so quickly, then this wouldn't be as necessarily as much of a concern. And like we've talked about before, people are aware of this problem. It's not that we aren't working on it. It's not that we aren't building out additional generation assets or reliability mechanisms or battery capacity. We are. It's just that this is an issue that is not quick to fix. This is something that is going to take, there's a lot of legislation. And once you're through the legislation, the construction timelines aren't necessarily the most expedient. So we will continue, ERCOT particularly, really above a lot of other markets. We are going to continue to see a ton of elevated price levels and volatility. I'm sorry, I know it's not great news. We have operated reliably during Winter Storm Kingston. That was the freeze that came through in February. We set an all-time winter and 2 new February peak demand records. We were up at about 80,000, a little north of 80,000 megawatts. This surpassed the previous peak, which was set by Uri. And the winter peak that was set by Uri was only 69,000. It was about 70,000 megawatts. So we grew 10 megawatts since Uri in setting this peak. It's great that we didn't have any of the issues so much that we had during Uri with reliability. We didn't have to necessarily, we didn't have to shed load. We didn't have to break the market. But really thinking about the peak that Uri set and what happened and the growth that we have seen in that peak, just think about how exponentially we are going to need to grow. If we were to have to handle another outlier storm like Uri, then that number would be even bigger. We like I said, we got through it okay, and I'm hopeful. I know we're supposed to get a little bit more winter weather. We're not quite done yet, but this is something to keep an eye on. It's really something that I think, thinking back, I'm a born and raised Texan. I've lived there most of my life, and seeing the weather change, seeing these harder winters hit, has really, it's changed my perspective in terms of the ways that I would want to manage, kind of my risk if I were operating. So. I also wanted to touch, we did release the latest capacity demand reserve reports. This continues to highlight these challenges in really maintaining resource adequacy, maintaining reliability. We have these declining planning reserve margins. These projections indicate that reserve margins are going to decrease significantly from 2025 to 2029, potentially turning negative by next year or the year after. 2026 or 2027. The decline is attributed to these factors that we've been talking about: addition of large customers like data centers and crypto mining, industrial facilities, etc., and evolving grid management practices. We are seeing an incredible amount of demand growth, and this, like I said, this situation is unfortunately not an easy one for us to get out of. We're going to continue to see a lot of volatility. We're going to continue to see a ton of elevated pricing levels in Texas, really, truly for the foreseeable future. Yes, things could change, but the unfortunate reality is that we're going to continue to see that volatility until they do. And really, with a forward look, the potential for that upside risk is just so much higher than any downside benefit. You can see that in these pricing levels that we have here. We are really navigating a dynamic landscape. We have our own regulatory challenges. We have our own market challenges. We're really, we are working increasingly on paying attention to this issue. It's not that I've talked about this with a lot of our consultants. It's not that nobody's aware of the issue. Certainly, it's just that this is something that is complicated and quite expensive and time-consuming to fix and to remedy. We are going to continue to see some reliability issues, and if our weather continues to be as harsh on us as it has, thinking about the freeze is one thing, but we've also been having significant windstorms that can knock out our transmission and cause other issues. So I really like to think about the practicality of electricity. A lot of this in our day-to-day boils down to numbers on a screen, but that's not the reality. That's not the reality that people live in. People expect that whenever they flip on a light switch, that the light turns on. And the more we think about the practicality of our grid and grid strain, the more that we think about our transmission and how difficult, how time-consuming and expensive it can be to build, the better we are going to understand these challenges, and the more adept we're going to be at advising in this market. So that's our ERCOT summary. Like I said, It's not necessarily all good news, but for those of us who are working in the industry, I also like to think that with challenge comes opportunity. Customers are going to need your help. Customers are going to need to understand what is happening and the ways that the market is absolutely, completely, fundamentally different than it was 5 years ago, and even more so than 10, 15, 20 when it first deregulated. It's worth having those conversations with your customers and educating them and showing them exactly why pricing levels are so high. And yes, there are some definitely creative ways that we can help manage these increases, help manage those costs. But that's, you know, that's it. It really gives us some opportunity, but it can be a tough conversation. We understand. If you're looking to have those conversations and don't necessarily know where to get started, or you want some backup, give us a call. Scott, do you have things to add on the ERCOT? I know this is kind of a
you did a great job.
exponential view on your market fundamentals, but
yeah, you did a great job. You nailed it. I mean, I read something today how Texas is now, if it was a standalone country, it'd be the seventh largest economy in the world. So yeah, I mean, and it's
that's
growing.
changed from we were the 10th in 2019.
Yeah, so it's growing. You know, I don't think others are shrinking, but yeah. So, but they've done a fabulous job in ERCOT of kind of, since Winter Storm Uri, of making the right changes. I think they'll. But with that being said, it's growing. It's growing enormously. It's really hard to keep that up, and so you got to manage that risk appropriately. Questions, and just one question here, and it's regarding tariffs that Ontario was going to do, and in fact, yeah, that would have had. It was really way overplayed of what effect that would have had on the grid, and really less than 1% of power, and most of that's going to Michigan, maybe some of it to some other states, but nothing really a huge impact on where we have customers. Minnesota, for instance, there's no deregulation there. So more just if Quebec comes in into hydropower, and that is a little more in upstate New York and some New England states, have a little bit more effect, but it's not something we're really kind of like, oh my gosh, this is crazy, prices are going to go skyrocketing. We're not really seeing that. Some tariffs though on natural gas, that can have a little more impact because we get, you know, a decent chunk from Canada, and there was a drop when there was a confusion, a drop about 2 or 3 BCF for about 4 or 5 days, and there's a confusion on the tariffs. And the last thing about the tariffs, things like aluminum, things like that, and other parts, these are going to impact on things that we need components for the power grid and stabilizing it, and also drilling wells and all this stuff. So these will have increased costs in those areas. So and what kind of impact that will have, we'll see, but it's going to change the economic picture slightly. But that's it, really. That's all the questions we have. Thanks, everybody. Looking forward to another webinar next month. We'll get the date out there shortly. Everybody have a great month here. Great start to the spring. Have a great day, guys.
Thanks.
Bye.